Let's take a look at the bond market this morning. Right now, it looks like the 10-year is at 4.45. The 2-year is at 3.99, just below 4%. Try and figure out what it is telling us right now. Joining us for more on that is Kelsey Berro. She's fixed income portfolio manager at JPMorgan Asset Management. And, man, it has been a confusing ride with the Treasury market over the last month and a half. What is it telling us now versus what it was telling us 6 weeks ago?
Yeah, so I would say that the major move in the bond market, there's been kind of two different parts of the curve, of the yield curve, of the Treasury curve, operating in essentially different universes. One is you have the front end of the yield curve. That's been driven by Fed policy. And what we've seen as there has been this 90-day pause between U.S. and China on tariffs is that the market has repriced the front end of the curve. So the market has gone from pricing about 3 to 4 rate cuts this year to around 2 rate cuts this year, starting in September, maybe 1 in September, 1 in December.
Right.
So you've seen the front end move up marginally, repricing the Fed's policy path because recession risk has come down.
That's what I was going to say. So a recession is much less likely at this point. That's why we see rates at these levels. But do you anticipate rates will be lower 3 months from now?
Yeah, so we have been expecting a range for the 10-year Treasury yield, now moving kind of out the curve, of 375 to 450. So if you look at 10s right now at 445, we're at the higher end of that range. And I think there are risks in the short term, reasons why yields may be biased a little higher, particularly focusing on the budget reconciliation discussions and what that means for the deficit. But more broadly, we do think that you're at the higher end of the range. And one of the reasons why yields should be more range bound here is that while the Fed rate cuts have been pushed out, we're still a long way away from thinking about Fed rate hikes. The Fed is still in a neutral to easing bias.
Okay, but that's a really interesting point, that there are two different factors that are driving these things. For the 2-year and shorter terms, it's what's happening with the economy. For the 10-year, you think it's far more about what happens with the budget and budget reconciliation. If there are not cuts, significant cuts that are put into spending, how will the market react? Forget about the Fed if they're not controlling it.
So I do think that some of the budget expansion is already priced into the market. So if I think about what was priced as we headed into Trump 2.0, it was the extension of TCJA that was not going to be funded.
The 2017 tax cuts?
Exactly. Yeah. So extending those tax cuts, making them permitted. I think that is generally in the price, the expansion of deficit associated with doing that. The question is, above and beyond that, the other tax cuts that Trump wants to do, how much of them will have offsets associated with them, which is why these negotiations are of such interest to us, particularly what can they get done in terms of, on the Medicaid side, in terms of where are those pay-fors essentially going to come from. But I do think some of this budget deficit expansion is already priced. Long-end yields are quite high relative to history even now. And they have remained fairly sticky, even as we've seen some of the volatility in the front and belly of the curve.
The Wall Street Journal's editorial page took a particularly strong stance about the cuts that never materialized in Medicaid. Is this a reflection of that, too, what you're seeing in these prices at this point?
So I do think that the longer end of the yield curve is more elevated than it would be otherwise because there is expectation for the deficit to stay large and to get larger. But the real question is, for the Treasury market, it's less so about the deficit itself and more so about, is the deficit going to cause more growth and more inflation?
Okay.
Right? And so the extension of TCJA in and of itself, I don't actually think is particularly expansionary for growth or inflation because those tax cuts are already there. We're just extending what is already in the system.
President Trump has been very vocal about wanting the Fed to lower rates. If this budget goes through and there are not more cuts that come along with it, does it matter what the Fed does, or would the market speak up on the long end at least and say, we still don't like what we see, so even if you cut rates, we're going to move rates higher? Over the last 100 basis points that the Fed has cut, we've seen yields higher.
Ultimately, it depends on where the economy is going. So I think in the last few days, we have somewhat lost sight of the downside risk to growth associated with this tariff regime. So just to take a step back, heading into Liberation Day, we had a view that the effective tariff rate for the U.S. would be around 10%. That would slow the economy, but we would avoid recession. That went all the way up to 20-30% during the period of escalation between the U.S. and China. Now we're somewhere in between that 10 and that 20%. We're at 15. That is still a very high tariff rate that is still exhibiting a lot of uncertainty for businesses. And ultimately, if the economy is slowing and inflation is moderating outside of the goods sector where you're going to see the hit from tariffs, I think there is, again, a limit to how high yields can move here.